But there's a lot of news flow that's surrounding banks today. In a major boost, RBI has empowered banks to go for the kill over bad loans. Lenders can now restructure loans by converting debt into equity if borrowers fail to meet viability milestones under the restructured plan. Also, Federal Bank in particular is in focus after the bank cut their base rate by 25 basis points to 9.95% effective the 18th of June. Shyam Srinivasan, the MD and CEO of Federal Bank, joins in to talk about all of these news points. Mr. Srinivasan, thanks very much for joining in. First, let me talk to you about your base rate cut. You've cut it by 25 basis points. How much of an impact could it mean for your net interest margins, if any? And is there scope to cut further?
The impact on margins, we'll have to see. The entire benefit of the cost of, or rather repo cut has not really translated into cost of funds as yet. But if you take a longer period through the year, I'm sure between improved credit volumes, better growth in our lower cost deposit products, I'm confident that our margins will be on or around the same as it was last financial year, which is around 3.2 to 3.25. So I think on a full year basis, I'm not very alarmed that the margins will get impacted as long as the cost of funds keeps going down. In terms of incremental rate cuts, we'll have to see how things play out and whether there are forthcoming rate cuts coming on the repo side and how overall business environment and credit growth is. We were encouraged with good growth in our low-cost deposits the last 2 months. That helped us give the confidence that the underlying input costs can improve in the course of the year.
Okay. The RBI has cut the rates so far by 75 basis points. How much has Federal Bank cut its rates so far in 2015, sir?
In 2015, this is our first cut at 25 basis points.
Okay.
Last year, ahead of many banks, we had cut 35 basis points. So we had come down to 10.20, now to 9.95. So effectively, our rate cut for the calendar year 15 is 25 basis points. This is the first cut for the year.
Okay, let's talk about now the RBI news, where they now allow lenders to, restructure loans by converting debt into equity if borrowers fail to meet, the kind of requirements that have been set out in the talks earlier. Do you see banks increasingly now taking advantage of this new empowerment by the RBI, or do you still think banks are likely to be more conservative and reserve this only for the worst of the worst cases?
Very situation specific, but I think it's a very good enabler that has come and will certainly be a potent weapon in the hands of the banks to work with clients who mean well but have run into a problem. So I think this is a good enabler, and its use will definitely be situation specific and client specific. I can visualize banks like us looking at 3-4 clients who have had challenges for the last year or so being this is a good discussion route with them. But you must remember that it's a continuum. The JLF was formed, the sharing of information came through. Now there is one more armory in the toolkit to go and negotiate and find a better solution to what looks like a stress situation. But at the heart of it, it has to be a well-designed and wanting to make an improvement kind of situation. If it's wrong intent, this won't work.
But sir, why do you say this will be a good discussion point? Won't this now become mandatory?
No. Mandatory is on many counts. The shareholders of the borrower need to come to the party. If the rationale is good and it is fairly diversified, they will certainly want to, because the enterprise value will go up if indeed all the banks come together and make an impact and get a good promoter in. Certainly the benefit will be for everybody. But if the core design and the intent is not good, then this is as good as it is on paper. So I think the intent is good, the enabler, that it's a good enabler is there. Mandatory is a function of how everybody agrees to make it happen. I mean, banks cannot singly make it, force their way through if the shareholders of the other side don't necessarily agree.
Okay. You said perhaps you will consider this route with 3 to 4 clients in your earlier answer. Can you elaborate and give us some more details on that? And secondly, any challenges that you foresee in execution of this?
Execution is, like I mentioned a while back, is certainly around the ability of the company to attract the right kind of promoter. The banks may be keen to get in a promoter, but at what valuation will they come and what will they get out of it. So that is, therefore, the execution isn't really the operationality of making a business case attractive. And of course, the shareholders of the company borrower agreeing to participate in this. In terms of names, I can't get specific with names, but there have been accounts that have had challenges, who've worked out many routes. But here comes an opportunity of all the banks coming together, taking equity ownership, and then trying to get a promoter in. So those names, I mean, I can't quite name specific, but yes, there are names that can be certainly looked at. And we are not the sole bank, so we'll have to work with other lenders to see how this appeals to all of them. But it's literally less than 24 hours, so we'll commence our discussions with the parties, both the borrower and other lenders.
Okay, so my next question is based on the assumption that, this move is not handled very arbitrarily by the banks, that it's on a case-to-case basis. What then might be the pipeline of asset sales for the industry that you see going forward? And might we see one or two as early as FY16 or FY17 itself?
I think the instances could be more than one or two within the next 12 months. The quantum, frankly, I have no way to hazard a guess on how big it is, because there could be one or two large banks who may want to explore one big asset through this route. So that can swing the factor. But I think the examples of it can happen in this financial year. How successful may mean in the years ahead that it can take some growth. But I held the view for long that in some cases this is more sensible from the point of view debt was actually getting equity-like pricing in the past. Here is an opportunity to convert your debt into equity and start commanding those kind of outcomes. So I think the pricing arbitrage that was there is now getting normalized for clients who have not had either good business models or good business intentions. So I think this is going to sort of sort that out in perspective.
All right, so we'll leave it at that. Thanks so much for taking the time out and joining us on CNBC TV 18. That's the view on Federal Bank post the base rate cut that they have enabled, as well as the view on the strategic debt restructuring which has been announced by the RBI.